All right, we are live right now. Um, See if the viewers are going to be in here or not. Give me a second. Yeah, it's. I mean, it says 0 viewers, but it says that I've got 7 viewers on the bottom.
Hmm.
Well, maybe we can. Oh, there's 2 viewers. 1 viewer now.
It's not me, is it?
Just wait for people to start coming in. So far, I've got 2 viewers. Probably give them 3 viewers. Wait a couple more minutes for everyone else to come in.
Okay. So when it says live right now, everyone can hear us, and
Yeah.
okay.
Let me see if I can chat these guys and let them know that it's starting.
Okay.
I don't know, should I? All right, now I've got 4 viewers, so I think people are starting to join in. Wait a couple more minutes.
Okay.
Alrighty. Oh, cool. We got 5 viewers. We'll start now. All right, so guys, my name's Pat Doherty. For you guys who don't know me, this is our first-time homebuyer webinar. I've got with me Bill Scatina. He is our loan officer and sales manager. Say what's up to everyone, Bill. Introduce yourself.
Hey there, Bill Scatina. Like Pat was saying, I'm a mortgage loan originator working in the Lincoln Park office. Been doing this for about 12 years, and I'm happy to be on the first-time homebuyer seminar.
Awesome. So I'm just going to kind of run through what we're going to be talking about today. Um, Basically, just everything you need to know about buying your first home and some of the topics and issues that we're going to be covering. First off, the main thing I want to hit home with you guys is renting versus buying. Most of us who are kind of in that millennial age group are renting apartments in the Chicagoland area and super high rent districts. So, I want to just give you guys some information and education and offer you guys some alternatives to renting, and that is just buying and owning property. So we're going to be covering renting versus buying, the pros and cons, and then we're going to be moving on to a timeline for first-time home buyers, just kind of, the sequence and the process of how everything works. Then moving on to mortgage interest rates and what that means for you guys, how credit affects your loans, and seeing about how much home you can afford, and looking at that $300,000 home and what I have to do to qualify for a mortgage to suffice for that amount, choosing the right loan program, and on the loan application process, and also having your documents in order, and just saving you guys some time and some headaches, and just going into it, being knowledgeable and being prepared. So what I want to do is I'm going to screen share the PowerPoint presentation that me and Bill have, and we are going to go through the presentation, and then at the end we're going to open it up for some questions. I know I've got some questions from people that they have submitted, and open it up to you guys, and we're just going to go from there and do some Q&As. So I'm going to screen share right now the PowerPoint. Awesome. So, Bill, you can see this, right?
Yep.
Awesome. So just take it away whenever you want to start. We can just go down to, this is the agenda that I just read off, and we could start with kind of our main focus for people in my age group is just renting versus buying and the pros and cons.
Okay, sounds good, Pat. Thank you. So yeah, one of the main topics that Pat said he wanted to cover was just the advantages and disadvantages compared to renting versus buying. As you can see on the screen in front of you, some of the advantages of renting, monthly rent can be cheaper. In Chicago, that tends not to really be the case when it comes down to what a mortgage loan would cost you on a monthly basis. A lot of times it works out where it's actually cheaper than renting in some of the higher rent districts of Chicago. Relocating could be somewhat easier because you don't have to sell a house, and then maintenance costs, because I'm sure most of you have a landlord that's responsible if something breaks in your place, where if you own a house, that's your responsibility. But the advantages of home buying definitely supersede those of renting. If you rent, you don't get any type of tax benefits or interest deductions that you can claim on your tax returns. You're not building any equity. Every time you make a mortgage payment, your balance goes down, and if homes appreciate, you're going to see that much more of a return when you do sell your property. No investment or appreciation value. Homes tend to appreciate in the Chicagoland area up to 10% a year, sometimes more in different areas. You start to see that advantage when you do sell the property. Rent rates may increase. I don't know if some of you are in second, third, or fourth year of renting, but your rents might have gone up. So that's something that you don't have to worry about with purchasing. And then there's limited options just for decorating and personalizing your place when you rent compared to own. So moving on to the next slide. Okay. This is a timeline for you of how the process works from, hey, I'm interested in buying a house to my closing date. So the first thing we recommend is that you meet with your loan officer, your trusted loan officer, like myself, to discuss the different financing options. At that point, we would then do a pre-approval or a loan application to determine how much you can afford. Then Pat would take you out with the pre-qualification letter. You'd go and look at certain places. Once you're interested, you would submit an offer. If your offer is accepted, you have to put down what's called earnest money, which is your initial deposit that secures the purchase of the new place for you and your commitment. You would then arrange a home inspection to have a licensed home inspector go through, walk through the property, make sure that everything's on the up and up and there's no major repairs that are going to be needed. You would then purchase homeowners insurance and finalize any conditions in terms of the sale. Prepare for closing by reviewing the costs and fees with me as the mortgage loan originator. Then at the final closing, you'll sign all the loan documents to finalize the purchase. The title officer will ensure your documents are properly recorded with the county, and then you move into the home. So moving on to the next slide. Here is just a summary of interest rates historically. As you can see, there's been peaks in rates in the 1980s and 1985. That's where rates were all the way up over 17%. If you could see towards the end of the chart, 2015, we're at pretty much historic lows right now. So that also plays in as a great factor of a pro for purchasing instead of renting. With the historic low interest rates, the monthly mortgage payments are at historic lows as well because interest rates affect your monthly payment. So moving on. Okay. A lot of people, and a common question is, how does my credit score affect how much I can afford or if I can get approved? So almost every single mortgage progress or a program requires a credit score. Your credit rating affects your loan interest rate. Generally, the higher the credit score, the lower the interest rate, because the lower the risk you are to the bank of defaulting, and they like to take in your credit score into that because it shows your willingness to repay loans. After taking your initial loan application, we would then assess your credit by pulling a credit report. There are different loan programs available for buyers with minimum credit history and less than perfect credit, which we can discuss at a further time in the presentation. And then we can give you copies of your credit reports. We pull 3 bureaus, which is Equifax, TransUnion, and Experian. And they can be viewed at annualcreditreports.com, so you can view them to make sure there's no errors on your report that I can also help with getting removed for you. Moving on. So your credit score is made up of a few different factors. The 5 things listed below: timely credit payments, as long as you're not missing payments, that helps your credit score. Amount of debt owed also can affect your score. If you have a lot of credit cards that are maxed out, that's when your credit score really starts to take a hit. Number of recent credit accounts opened. If you've opened 4 or 5 department store credit cards in the last 30 days, that could lead to hurting your credit score because you could be a credit risk that you're extending all these new lines of credit. Number of credit inquiries. If you're having your credit pulled multiple times in a short period of time, that can hurt your score as well. And then the type of credit used. Installment debt is good debt. So if you buy car loans, any student loans, anything that has a fixed payment every month is good. Anything that's revolving, like a credit card, that's an unsecured loan, those payments fluctuate by how much debt you take out. So those are types of credit that's bad credit that hurts your score. Your credit score is part of the mortgage information that dictates whether or not your application is approved, and your credit score may be a factor in determining the mortgage interest rate that you pay. The higher the credit score, the better the rate. Moving on. How much home can I afford is a common question. We believe that the best home loan we can provide you will have a lasting affordability built in. Your maximum loan payment combined with other monthly debt must be less than your monthly household income, okay? So what that basically means is when a mortgage loan originator looks at your willingness to pay back a loan, they take into consideration anything that reports on your credit report. So if you have a car loan for $300, or if you have a student loans that total up to $200, or monthly credit cards that total up to, I don't know, $100 a month, all of those payments, along with the new payment, estimated payment on your new loan, cannot exceed 45% of your gross monthly income. So basically what that means is, for an example, say you made $10,000 a month before taxes, 45% would be $4,500. So all of your monthly expenses including your new mortgage payment cannot exceed 45% of that amount. Okay, so moving on. So types of mortgage products that are out there. The conforming loan limit in all of Illinois is $417,000. So as long as your loan amount is $417,000 or below that, that fits within the conforming loan limits. Anything above 417 is what's considered a jumbo loan. Jumbo loans have a lot more restrictions and underwriting guidelines than conforming loans. So that's something to take into consideration when looking at properties. Then there are government loans, which FHA is a loan that only requires 3.5% down payment. And then VA loans for any veterans out there. There are loans all the way up to $1 million with 0% down payment options. Okay, moving forward. What type of documentation will you need to be approved for a mortgage loan? So first off, like we talked about, you have to have a credit report, so we have to pull your credit score. You have to provide pay stubs for your jobs, so we need to detail 1 month's pay. So most people who get paid every 2 weeks, that's 2 pay stubs. We need your bank statements for the last 2 months to show money available in the account for down payment. Your last 2 years W-2s from your employer, or 1099 for those of you who are self-employed, and then copies of your last 2 federal tax returns. Okay, moving on to the next slide. Okay, so here are some things to consider when choosing the right home. Do you plan on working with a realtor? Yes, you do. Pat's our trusted realtor here hosting the event, so he would be the expert to showing you the different areas that you want to look into and finding you the right home to show you. Present and future housing needs with your family members. So with growing families, that would determine if you want to buy a 2-bedroom place, 3-bedroom, or 4-bedroom, but that's where Pat would take it from there. You know, how many bedrooms, bathrooms. You know, Pat would go through all of that stuff with must-haves in the neighborhoods and cities and areas that you want to look into, and how far the commuting is from work and distance and traffic. All those come into play. Moving forward. Stearns Lending is the company that I work for. We were founded in 1989 by Glenn Stearns. We're licensed to lend in 49 states, so if you're not looking to buy or you do get relocated, I can definitely assist in outside states. We've funded $35 billion in the last 3 years, and we are a direct lender. So what that means is when we originate the loans, we also service the loans. So most lenders out there, they sell their loans off and you're done with it. After the loan is completed with me at Stearns, your loan stays with us. So any questions you have going forward with your bills or anything like that, I can assist you with that. And my office is located in the Lincoln Park area on 1901 North Clybourne, so I am easily accessible as well. So that's all that I have in terms of the actual presentation itself. We have some common do's and don'ts when applying for loans that Pat's going to show you, and then we'll have some Q&A that Pat has prepared for us as well. So things to do when you're getting pre-approved for a mortgage. Make sure you're making all your payments on time. Any missed payments would definitely affect your credit score, which could definitely impact whether or not you're going to get approved for a mortgage. Keep receipts of any deposits that you make into your bank account that are not from payroll. So if you get a $1,000 check from someone that's paying you back, or you get Christmas money or anything like that that's being deposited as cash or as a check, we have to document any type of large deposits that are not from payroll. Minimize any type of transfers from bank accounts. When you're transferring from bank accounts, we always have to show a paper trail to the underwriting department. So it's important that you keep records of any type of transfers. Submit any type of gifts that are given to you. If you come into money from a family member, we have to document it with a gift letter. So We'll have to show a copy of the check that's been deposited into your account along with a signed letter from the family member gifting you the money. Keep copies of any type of new pay stubs from any new jobs. If you just started at a new company, we have to show the last 30 days worth of pay stubs, so make sure you hold on to those. You have to notify us immediately of the following changes. If you switch employment, that can impact your loan. Any type of new income or assets or anything that might have affected your credit history, all those things will come up, so please notify me of those type of changes, and marital status changes as well. You'll need to keep proof when you make your earnest money deposit. We have to show that the money came out of your personal bank account. So we'll have to keep a copy of the check once it clears your account to show that the money did come out of your account. We'll have to be in contact with your homeowner's insurance provider. So at least 3 weeks before your closing, we'll have to know who you're selecting to insure the property, because we'll have to get a copy of your new insurance policy deck page and proof of payment. So that is important. Please notify us if you plan on taking any type of vacation or depart on any business trip during the loan process. Throughout the process, we need to request certain documentation, so it's important that we get that in a timely fashion. So we'll need to be notified if any vacation where you'll be unavailable. And then calls for any reason pertaining to your loan and loan process. We're always available. I stick with it through beginning to end the loan process, so please notify me of any questions that come up at any time. Okay, moving on to the next slide. Okay, so these are important things to avoid during the loan process. Please do not make any type of expensive purchases. Before the closing, the underwriter does what's called a soft pull, where they look at an updated credit report that sees any type of new purchases you made. So if you bought a new car and the payment's $300, they're going to see that, and if that affects your debt ratio, that could complicate and potentially ruin the loan process at the very end. This does come up every once in a while, so it's important to limit any type of credit card usage or opening any new accounts during the process. Starting a new job may cause a concern. If you do start a new job, we do need to show at least 30 days worth of pay stubs at the new job. So if your salary, that's a better thing, because we can show from the employer that you are going to be getting a salary of X amount of dollars. But if you switch from a salary job to a commission job, they need to show a 2-year history, so that would definitely deny your loan at the very end. So that's something to keep in mind. Don't switch banks or move money around. Like I was just saying before, we have to always document and source any type of money. So if you're opening new accounts, we're going to have to show paper trails of money leaving other accounts and going into the new account. Don't plan a move date around your close of escrow. The reason that we say this is we want to make sure your loan is secured and ready to go for your closing. So we don't want to have your moving date and movers coming, let's say March 10th, and we're trying to close March 9th, and for some reason something gets delayed with the seller or anything like that, and your closing gets moved to March 12th, and now you've got movers ready for March 10th and you have nowhere to live. That could pose a problem. Don't disregard your lender's requirements. Even though you may be pre-approved, we do have to make sure that we're constantly looking at updated bank statements and pay stubs and things like that could affect your loan. So it's always important that you stay in contact with me as your lender to let me know of any of these changes or anything that could impact your loan approval. So that's pretty much the major do's and don'ts. And that's all that we have for that section. So we'll move on to the next questions and answers that we can address and take it from there.
Awesome, Bill. Thank you. I'm going to stop the screen share right now. I'm back. Okay. So the first thing I want to do is just kind of open it up for questions, and I'll start just to kind of kick things going. So Bill, can you just again reiterate just the benefits of renting versus buying, and just maybe people don't realize how that renting is a complete 100% financial loss, and maybe explain to them about, what equity is and how they can pull equity from their home after owning it for a certain amount of years.
Okay.
I actually just had on my first sale in November, the woman bought the house in 2013, and then she resold it in 2015 for 70 grand more than what she bought it for. So that's pretty good for just 2 years and not putting too much work into it. So if you kind of just talk about that a little.
So yeah, when you rent a place, some of the benefits are you're only signing a 1-year lease. So after the 1 year, you can either stay there or move on to the next place. Besides that, you might be able to rent in certain areas of the city that you couldn't afford to buy a property. Those are the only real benefits I see of renting. But the benefits of home ownership are so extreme that a lot of people don't really understand. The one big benefit is every time you make a mortgage payment, you're paying interest. That interest at the end of the year is tax deductible that you get to write off on your tax returns. So if your payments are $1,500 and $1,000 of that is interest, at the end of the year, you'll have $12,000 in interest that you get to write off on your taxes that would probably help increase your tax refund at the end of the year. Building equity, like you were just mentioning, is a big thing. Homes tend to appreciate. So if you buy a house for $200,000 in 2013, on different parts of the city, we're seeing greater appreciation than others. But if the property is worth $250,000 in 2015, you just picked up $50,000 in equity if you sell that property. Down the road, if you want to purchase more properties, you can tap into that equity to help towards your down payment on the new place. There are such things as equity lines of credit or cash out refinances where you can actually tap into that equity that you just gained by the appreciation in the market to put down as a down payment for new properties. That's some of the big benefits that we didn't really go into much detail on in my presentation, but yeah, that's where I would like to touch on.
Awesome. So with that being said, Bill, can you give some advice or words of encouragement to someone who thinks that owning property is just too big a step for them, or it's way too far in the future, and that they don't need to think about this stuff yet?
Yeah, absolutely. There are so many great loan programs out there that require limited down payment. The most common mistake that everyone thinks is that, oh, well, I don't have enough saved up, I can't afford a place. I mean, there's programs for veterans that are 0% down. There are other loans that are 3 to 3.5% down loans where a majority of that can come as a gift from a family member. So a lot of my first-time home buyers, do get gifts from family or extended family to put as a down payment, and then it ends up being where their monthly payment with their taxes and insurances on the new place is equal to or slightly even less than what they're paying in rent right now. And then after that, they're going to, get all those benefits that we just mentioned with the mortgage interest and the appreciation over the years of owning.
Awesome. Yeah, totally agree. What's the minimum down payment that someone has to have? Is it always like a percentage of the list price, or how does that work?
So for a purchase, it's always a percentage of the purchase price. So if you've agreed to a purchase price of, let's say, $100,000 for easy simplicity purposes, if you're a veteran, there's 0% down payment. So you literally have to bring zero money to buy the house. There's other loans. Conventional loan has a minimum requirement if your credit score is at least a 700 of only 3%. Then FHA, which is a government-backed program, you only are required to put down 3.5%. Through that product, they have credit score requirements of all the way down to a 580 credit score, which is actually considered a bad credit score. So that just shows you that there's programs out there that you're only needing 3.5% even with not excellent credit.
Awesome. The next question that someone asked was, explain how student loan debt comes into play when applying for a mortgage. So, if we're looking at someone who's, maybe around my age, maybe they don't have, a whole ton of credit or a whole lot of credit history, and they just have student loan debt, and maybe they are, just renting right now.
Yeah, so student loan debt is what's considered good debt because that's an installment loan. They tend to have fixed monthly payments, just like a car loan would. A lot of student loans for first-time home buyers that I've dealt with in the past are still in deferment. So under the FHA product, if those loans are in deferment for at least 12 months out from the date of our closing, we don't have to count any type of payment against your monthly debt to income ratio. If we do a conventional loan, we have to get an estimated payment once they come out of deferment of what those student loans are going to be. So depending on how expensive those are, even though they're not making the payments on them now, in 6 months to a year from now when they come out of deferment, we have to take those into consideration under that product. But under FHA, as long as they're deferred over 12 months, we wouldn't have to count that against your debt ratios.
Okay. How long does this process take? This whole loan process. Like, should I set aside like a couple weeks or a whole month or?
Yeah. So the biggest challenge I think up front is finding the right property. So a lot of people are trying to always time it out with when their lease ends. Like, oh, my lease ends. I've got to be out by June 1st. When should I start the process? Well, it also depends on how long it might take you to find that right property. So it's never too early to start looking to secure the house that you want. So once you go under contract, we always say to give around 30 to 45 days, depending on the complexity of your particular loan scenario, but typically 45 days from start to finish of once you go under contract to the day that you go to closing.
Okay. Another question that someone sent in was, how long do I have to be working at my job before I can qualify, and what if I've only worked for a year?
Yeah, so that's a great question because depending on the way you get paid all determines that. If you're a salaried employee, we actually only need your first pay stub to show that you are receiving that salary that's agreed upon. If you're a commission, if any of we need commission income or bonus income, we need to show a 2-year history of you receiving that income to qualify. So say you get a salary of $50,000, but then you also have $50,000 in commission. We can automatically count the $50,000 in salary, but in order to count that $50,000 in bonus or commission, we have to show a 2-year history of you receiving that income.
Okay. So I've got another question. It's a scenario question. What if I had $25,000 saved up for a down payment and I had $15,000 in credit card debt? What should I do? Pay off the credit card debt, pay off half, pay no debts, and put it all as a down payment? What should I do?
So that's a good question. That's a particular question that once I would get a chance to review the actual credit report, I can give a better answer on that. The minimum down payment requirements that are required, depending on the purchase price that you're looking at, would determine how much of that would need to go towards the down payment. But paying down credit card debt is never a bad thing because once you exceed 75% of the maximum available credit on a particular credit card, meaning if you have a credit limit of $1,000 and your balance is more than $750, that starts to really draw down your credit score. So depending on your timeline, it might make sense to pay down some of that credit card debt to get your credit score improved before you actually go to get the loan, because the higher the credit score, the lower the interest rate that you would get qualified for. So that's a great question, but before I can actually give an actual answer whether to do one or the other, I'd have to actually look at the credit report to see what we're dealing
with. What is mortgage insurance? Why am I required to purchase it?
Yeah. So when you buy a property, if you put down less than 20%, there's something called PMI, which is private mortgage insurance. So all lenders require that you get this private mortgage insurance to hedge the risk of the loan. Because if you put down less than 20%, if we ever had to foreclose on the property, the bank a lot of the time would potentially lose money because they might not get back all of their investment if they had to sell the property for less than what the loan is for. So the amount of money that you put down determines how much that private mortgage insurance is on a monthly basis. If you put down 5%, it's a lot more than if you put down, let's say, 15%. So that's why you have to get private mortgage insurance. The government just released at the end of December, though, that private mortgage insurance is now also tax deductible. So you would have to consult with an accountant, but you could potentially write that off on your taxes as well.
Awesome. Next question is, what's the maximum household annual income to qualify for a 3.5% down payment?
So there is no maximum amount of income. The FHA insured loan, which is the 3.5% down, they have no maximum house. You can make $1 million a year, or you can make $50,000 a year. There's no maximum.
Awesome. And the next question is interest tax deductible in addition to the standard deduction?
Yeah, mortgage interest is tax deductible. At the end of every year, your mortgage company sends you a 1098 form, which shows the total amount of interest paid for that year. And then when you file your taxes, that's the amount that you would write off as mortgage interest deductions.
Okay. And that's all the questions from the viewers. And my last question that I have is, can you just talk about some investment opportunities that are out there? You know, if people are looking to actually invest in properties, you know, as a second home or vacation homes, or if they're looking to, you know, buy a 2-flat building and rent it out to tenants. You know, so what kind of investment opportunities are there, and how does that differ from buying a primary home?
Yeah, so there's a couple different options with that. If you're buying a multi-unit property and you're going to plan on living in one of the properties, that still falls under a primary residence. So if you bought a 2 or 3 flat and you're going to live on the first floor, you still fall under the primary home guidelines. So 3.5% down payment minimum requirement and so forth. If you're buying an investment property where you're just going to rent out those properties, you don't plan on living in any of the units, there are a little bit more restrictions on that. In most cases, you are required to put down at least 20% as a down payment, so that could get kind of costly. And the reason so is those are higher risk loans because you're not going to be occupying the property. Most people tend not to default on a place they're living in compared to places that they're just investing. A second home would be like a vacation home. Those only require a minimum of 10%. You're not allowed to rent those out, though. They have to be a true vacation home that you just go and, you know, vacation at or live at part of the year. And then, yeah, that's pretty much the differences on investment properties compared to primary residence.
Awesome. Well, that just about wraps it up. Is there anything else, Bill, you want to add? I think we covered a lot of stuff for our first webinar. Yeah,
no, I think that this is great. A lot of the questions that I do get are very specific questions, so please don't hesitate. My contact information is on the webinar. I'm always happy if you're 1, 2, or 3 years out. It's always good to find out the information up front, because if anything does need to get corrected on your credit or different things to get you approved for a better loan, it's always good to be proactive on that stuff.
Yeah, awesome. And if anyone is looking to, you know, buy a home or do anything in real estate, I would definitely suggest using Bill. I've used him once before, and he's awesome. So,
thank you.
Yeah. All right. So with that being said, thank you for everyone who signed in and joined us this evening. Hopefully we, you know, answer some questions, and you guys now know a little bit more than when you signed on. So thanks again. Thank you, Bill, and thank you for everyone who asked questions. And we'll see you next time. All right. See you guys.